There we go. And tonight's class isn't bad whatsoever. We're going to be taking a look at chapter 17. And chapter 17 is going to take what we saw in chapter 16 and simply put some numbers to it. We will also, in the way of numbers, see some journal entries and T accounts. So if you like journal entries and T accounts, you're in luck. If you don't, that's okay, because this is one of the very, very few places where we'll see them. So we'll see what you like. How many of you like journal entries and T accounts? Anybody like them? Good, you do, Amber. It's a good thing you're majoring in accounting. I like them too. But see, I'm an accountant, so sometimes my tastes are different. What can I say? So I'm going to share my screen here. And what I will be using tonight will be two documents. You're going to see one, which is from the chapter outlines, chapter 17. And then you'll also be seeing chapter 17 handout, chapter 17 examples. So this is a handwritten handout, and you've got some information here that's going to illustrate, excuse me, the examples I have, and you'll see the answers to them here. So let's see what we have in chapter 17, something called job order costing. And what we're going to be doing is determining the cost of one individual job as it goes down the assembly line. And that might be one unit, or it might be a batch of similar units as they progress together. Along with that job, not only will we be determining its cost, but also doing journal entries for it and T accounts for it. So I think generally it's pretty straightforward. If somebody doesn't like T accounts or journal entries too much, that's probably the main thing that comes up in the chapter. I will be reviewing the rules for debits and credits, just so that we have an even path there for journal entries. Here in chapter 17, in the first part, there are some things that I can shortcut because we just saw them. One thing that I can shortcut in Roman numeral 1 is the income statement and supporting schedule of cost of goods manufactured, because we just saw them in chapter 16. But let me ask at this juncture, do you have any questions about that? Anything there? Okay, so they're not too bad. Then Roman numeral 2, most of this we just saw as well. You can tell that I repeat topics from chapter 16 because sometimes I will have a 2-week break between 16 and 17, because sometimes there's a holiday toward the start of the term. So that's why I include everything here, and the book does too. So some terms that we saw, cost object, just anything for which a separate measurement of cost desired, like a product. Direct costs, we're talking about direct materials and direct labor. By the ways we will see in chapter 17, we can trace the exact amount of direct materials that have been used to the product and the exact amount of direct labor that's been used to the product as well. So we will know the exact number of dollars that product is consumed. An indirect cost, we cannot trace it like that. Instead, we throw it in a cost pool, which is overhead, and again, we will see tonight, then we allocate it. So that cost pool number 4, just a grouping of individual cost items. And the way that we will allocate it is with a cost allocation or application base. To allocate a cost or to apply a cost means the same thing. So this is a factor which is a common denominator for systematically linking an indirect cost to a cost object. It's usually a cost driver, which is a cause of a cost. And we will usually use machine hours, direct labor hours, or direct labor costs as our cost driver for overhead in this chapter, although other cost drivers are possible too. So for example, in a capital intensive process where we have more machines and people on the assembly line, like in producing the Lego bricks, that is something which is probably denominated based on machine hours, because the number of machine hours go up, the amount of overhead goes up too. On the other hand, if we have a labor-intensive process, as we saw in the video with making the Lego sculptures, more people than machines, then direct labor is more significant. So we may have direct labor cost or direct labor hours as our cost driver. In other words, as direct labor cost or direct labor hours go up, so will the cost driver of so will the amount of overhead. So those tend to be pretty good cost drivers in most cases. And we want that relationship of where the cost driver goes up and overhead goes up too. Then number 6, the term actual costing. That means tracing actual direct cost to a cost object or allocating actual indirect cost to a cost object. That will be versus normal costing, which we will also see tonight, which means tracing standard, don't worry about that, or budget direct cost to cost objects, or allocating standard or budget indirect cost to cost objects. We will do normal costing for overhead, and you'll see how we have a budget cost for overhead, a budget allocation rate. Excuse me. Then, with absorption costing, we will see this as well. This means including indirect costs as a part of the cost object. And by the way, it's one of the few places where GAAP enters in. GAAP requires absorption costing because GAAP does rule as we cost inventory, because something that will appear on the balance sheet. So GAAP says absorption costing, we have to include an allocation of overhead in the cost of what we produce. Now, by the way, in contrast, the term prime costing includes only direct materials and direct labor as a cost of the cost object. It's not in accordance with GAAP, so we're not going to use it. I mention it because sometimes it's used just for internal purposes. And prime costing is also known as direct costing and variable costing. Latter terms a misnomer because variable overhead is actually non-inventoried under prime costing. So just wanted you to see that term there in case it comes up at some point. If you take upper division cost accounting, which I would urge you to do because it's a good one after this course, we cover most material that's in there. Well, in there you will see prime costing. Well, as we had said, in this chapter, we're going to use a 3-part classification method. We saw that the other night. And thus, we will trace direct materials and direct labor directly to our finished products, and we will allocate overhead. So again, I will do that in some journal entries in just a bit. We'll remember that we have a cost pool. We're going to call it overhead control tonight, in which all manufacturing costs, which are not direct labor or direct materials, are accumulated. And just 3 notes here. Well, first, traditionally overhead include all fringe benefits paid to direct labor workers. However, these fringe benefits are increasingly included as part of direct labor, are therefore traced directly to production, rather than accumulated in overhead and then allocated to production. It is much more accurate if we trace the actual cost to the cost object, rather than pool something in overhead and allocate it or average it out. And again, we'll see that in some numbers tonight. So trust me on that for now. But if we think about fringe benefits, we can usually accurately predict the amount of fringe benefits per hour of direct labor. So let's say that we have a direct labor worker who is earning $10 per hour. And any ideas to how much fringe benefits may be in terms of a percentage? Anybody want to take a guess? Usually 30 to 35%. And things start adding up when we consider that some fringe benefits are mandated, such as the employer's share of FICA for Social Security. It's 7.65%. The employer pays that much and the employee pays that much too. So usually 30 to 35% is a good rule of thumb. So let's say once again that our direct labor worker earns $10 per hour as far as a basic wage rate. Then if we assume the fringe benefits are 30%, we would tack on an extra $3 and that would give us $13 per hour as direct labor cost. So if that worker works on the product for 2 hours, that product has just accumulated 13 times 2 or $26 of direct labor. Does that make sense? I'll put some numbers in just a bit in an example. And then number 2, we're going to use normal absorption costing in the chapter. And this means we're going to allocate or apply overhead to production via a predetermined or budget overhead allocation rate. It's normally computed at the beginning of the year. It's because at the beginning of the year, well, we need to know some estimate as far as what the overhead allocation rate is going to be so that we can cost products. And you'll see that. And again, I will put that to some numbers in just a moment. Well, that rate is going to be budget overhead cost divided by the budget quantity of the cost driver or allocation base. Then when we allocate some overhead, we will use this predetermined overhead allocation rate times the quantity of the cost driver that's consumed. So again, I have an example for you in just a bit. And that would be in contrast to waiting until the end of the year and applying actual overhead to production. And the above is performed on an annual basis to eliminate seasonal fluctuation. In other words, month to month, we can have a lot of fluctuation, but that evens out over the course of a year. And as we said, we're doing this based on budget figures at the beginning of the year. We might say it's more accurate to wait until the end of the year and have actual figures. That's true, but that does not help us run the business. We need much more timely information. And I will show you at the end of the chapter how we even that out in terms of some adjusting entries. So more to come. Then number 3, the amounts of direct materials and direct labor that will trace to finished products will be the actual amounts. And we would have turned to standard costing, sometimes called normal costing or budget costing, for direct materials and direct labor in chapter 23 if we covered that in this class. We used to, we don't anymore. We now save until upper division cost accounting. Well then, as we get into job order costing itself here in Roman numeral 3, first of all, do you have any questions so far? Anybody? Okay. Well, job order costing. So determining the cost of an individual product or individual job, which could also be a batch of products. So we'll be dealing with journal entries and T accounts in this chapter, and all inventory accounts which contain product costs in a factory, meaning direct labor, direct materials, and overhead, have normal debit balances. Cost of goods sold is an expense and thus will have a normal debit balance. So in saying that, those things probably sound familiar, but I think it would help at this juncture if I reviewed the rules for debits and credits. Let me grab a piece of paper from over here, and I will do just that. So let me write something down here and I will show it to you. Since I don't have a board to write on here at home, that's the next best trick. So what I do is I usually think of the rules for debits and credits like this. They differ from account to account. By the way, DR, debit, means the same thing as left. CR, or cred, means the same thing as right. So we need to think about which side increases the account and which side decreases the account. So down the middle for the account, I have a Lord. Asset, liability, owner's equity, I couldn't quite use equity, you'll see why in a second. R, revenue, E, expenses, and D for dividends. Can you see that okay? Okay, good. Again, like I said the other night, I wish I had one of those little blackboards like children have. So, or a little whiteboard, I guess, today. So, a Lord. Assets, liabilities, owner's equity, revenues, expenses, and dividends. So as we think about assets, which side increases an asset account? Debit or credit? Don't remember? Okay, it's a debit. So what I'm going to do is put a little plus sign on the debit side. So a debit is going to increase an asset account. Obviously, a credit would decrease it. So we often say the normal balance of an asset is debit because that's the side we expect to have the balance on, the side which increases, okay? So if assets are increased by a debit and obviously decreased by a credit, while on the other side of the balance sheet for liabilities and owner's equity accounts like stock, which side do you think would increase liabilities and owner's equity accounts, a debit or a credit?
Credit.
Credit, that's exactly right, Amber, because it's on the other side of the balance sheet. So credit's increasing to offset. Let me put a little plus sign on the credit side of each of those. Then, as we go to the income statement, think about revenues and expenses. If we have a revenue, in the end, that is going to increase retained earnings, which is an owner's equity account. So revenues are increased just like owner's equity accounts are, in other words, by credits. So I'll put a little plus sign on the credit or right-hand side for revenues. And then expenses, we subtract them. So they decrease owner's equity because they decrease retained earnings. So expenses would have which side increasing them? Which side would be the normal balance?
Be the debit.
You got it. Thank you, Mark. Yep, the opposite of a revenue. And dividends, they also decrease owner's equity. So they're going to have which side as a normal balance? Debit as well. So let me put a little plus sign on the debit side for expenses and for dividends. So there are the rules for debits and credits. Asset debit, credit for liabilities, owner's equity, and revenue accounts, debit for expenses, and debit for dividends too, okay? So that's just kind of how I remember them. There are other ways you can, there are various rhymes. One time some of my students came up to me after class and said that they had developed a little rhyme, and the way they were giggling, I could tell it wasn't exactly in good taste. They offered to tell me after class, but no, I passed that one up. I figured, please. So however it works for you to remember. Now in B, Well, traditionally, product costing was under either a job order system or a process system. Well, job order costing was traditionally used for products which are high in dollar value or which are custom made. And product costs are accumulated by the job, which again is one unit or a batch of similar units. Note that analogs of job order costing are perpetual inventory, where we continually track it. And in intermediate level accounting, you'll see something called the percentage of completion method for construction. That again is what, excuse me, where we continually track costs. And automation makes all three of these easier today. So in job order costing, we tend to track costs in real time. And that's just like a perpetual inventory system where we always know what we have. That is very cumbersome to do by hand, but much, much easier to do with technology. So job order costing has become a lot more common than it used to be, because the record keeping now, we don't have to do it manually. Now, we won't see it in this course, but there's also something called process costing. And that's used when units are extremely similar and are produced continuously. Process costing assigns product cost to individual units by an averaging system, and that's usually more efficient for such a process. For example, most consumer products, they're produced in a continuous stream and they're identical or almost identical. So for example, Publix, if we were to go on the west side of Lakeland here and we went to Publix dairy plant, we would see various products being manufactured. Not only dairy products, but also waters bottled there, orange juices processed there, ice cream, yogurt. And let's say that gallons of water are going down the assembly line. Well, Publix is, first of all, constructing the water jugs. They blow plastic into a mold, and then they fill it with filtered water. So it really is just filtered water. It's Lakeland tap water, which goes all over a good chunk of Florida. So at Publix, they would not use job order costing to continually track each gallon of water down the assembly line. Just wouldn't make sense. Instead, they wait until the end of a period and total up all the direct materials, all the direct labor, and all the overhead during that period, and they divide by the number of equivalent units of production. So we would do that if this were an upper division cost accounting course, but it's not. So instead, I'll save that until upper division cost. I like doing process costing, by the way. There are a lot of numbers with it, but if I didn't have a blackboard, that would be really, really difficult to do. So I guess I'm glad this semester that we're not doing it. But trust me, it's a lot of fun if you like numbers. Publix, by the way, the time period that it uses to total up all the manufacturing costs for process costing, they use a 4-4-5 system. 2 periods of 4 weeks. Okay, 1 period of 4 weeks goes by. They do the process costing calculations. They do them again after the next period of 4 weeks. And then the next period is 5 weeks, and they do them again. So any idea why they use the so-called 4-4-5 system? Any idea? Add them up. 4 plus 4 plus 5. 13. 13 times 4 equals what? 52. 52 is 52 weeks. A year, almost a year. So the year is not divided into nice, neat weeks. So Publix uses the 4-4-5 system. This way they have 4 quarters, nice and even in terms of weeks. And then they have a nice, even 52 weeks in their fiscal year. So Publix fiscal year ends on the last, I think it's Saturday of November. So it's not the same date every year. Pretty sure it's Friday or Saturday. I'm pretty sure it's Saturday. So that's how Publix does it. Now, to let you know, in number 3, we'll also study something called activity-based costing, or ABC, in the next chapter. And that's kind of a combination of the two. But again, we'll concentrate on just job order costing for now. Well, looking at C, in job order costing, the cost of each unit, each job, which again could be one unit or a batch of similar units, is accumulated as it progresses through production. And each job is assigned a job cost record to continually track its cost. Like we said, we're doing this in real time. It is like a continuous or perpetual inventory system. So we always know what we have on hand, and that's good. There's an example in your book, but I will show you a simple one in just a moment, which will be fine for us. But the job cost record shows the dollar amounts of direct labor, direct materials, and overhead the job is consumed or accumulated to the present time. We can note the job cost records of uncompleted jobs form the subsidiary ledger for work in process. So subsidiary ledger, you may recall from financial accounting that, for example, the accounts receivable control account in the general ledger, the big grand total, breaks down into individual customer accounts. Those individual customer accounts are the so-called subsidiary ledger. So that shows the detail. Same thing with work in process. Because the one big work in process account is the grand total, it consists of different jobs still on the assembly line at that time. So those individual job cost records for the uncompleted jobs on the assembly line will be work in process as subsidiary ledger. Then the job cost records for completed jobs not yet sold form the subsidiary ledger for finished goods. Same type of deal there. So those completed jobs that are sitting in finished goods awaiting sale, if we took their job cost records and added them up, we would have the total amount of the finished goods inventory balance. Well, of course, job cost records are easily automated. We can let the computer do them instead. But anyway, here's a simple one that we can do by hand. We're going to calculate the total manufacturing cost of a job, consuming $600 of direct materials, $300 of direct labor, and the predetermined overhead allocation rate is 30% of direct labor cost. Don't worry about 7 steps. We didn't discuss them. So to show you this, what I would like to do is to turn to this solution handout that I have. So the solutions which are in the examples. And for this one, I simply chart out the amount of direct materials, direct labor going into the job, and the overhead allocated. So direct materials, we were just told $600. Direct labor, $300. Again, we can trace those exact amounts to the job. Was overhead allocated? Well, we can't trace the exact amount. We have to allocate it or average it out. We are told it is 30% of direct labor. So direct labor being $300, let's take 30% or 0.3 of it and multiply. That gives us $90 of overhead that we allocate. So it's really saying on average that whenever we have $300 of direct labor, our overhead goes up by 30% of that, or $90. So $300 increase in direct labor is going to cause an increase in overhead of about $90. Does that make sense? Okay. Add them all up. The total manufacturing cost of the job is $990. That's a job cost record. Any questions there? Not bad. By the way, even though I put this problem together, I did not intend for this to be a significance, but happens to be. 990 is actually significant, and here's why. It is the income tax return for a not-for-profit, IRS Form 990. Sounds strange, a not-for-profit like Florida Southern files an income tax return, but they have to. They have to do that so the IRS makes sure they are truly not-for-profit. And a whole lot of information in there including information about amounts coming from donors. And our 990 is usually about 100 pages long. There's a lot in there. If you ever want to look up the 990 of a not-for-profit, by the way, and see how much they're spending on administrative activities, for example, you can always do so by going to guidestar.com and looking it up on there, guidestar.com, just to let you know. Now, indeed, we do have the manufacturing cost flow illustrated in the book. I'm going to show you the same thing with some journal entries and some T accounts here. So if that exhibit in the book clarifies things, so be it. If not, that's okay too. Now in E, I'd like to turn to an example of job order costing journal entries. We're going to assume the following occurred during a month. So we'll be doing journal entries and T accounts. You have everything on that handwritten handout. First thing I've got are beginning balances of $1,500 in materials control. By the way, some books will call the direct materials account materials control because it controls a variety of different direct materials. Some will call it simply materials inventory. Some will call it direct materials. Some will call it raw materials, all the same thing, but it is an inventory account. Then $2,700 on the assembly line in work in process. And again, some books attach the term control to it, but it is an inventory. And $3,900 in finished goods control. Some books will simply say finished goods, some will say finished goods inventory. I like to use different terms in case you see another term someplace along the way and you'll know what it is. Well, the significance of these beginning balances is that each of these three accounts, being assets, have beginning balances which carried over from last year. These are called real accounts or balance sheet accounts. You'll recall from the financial course that we do not close out real accounts at year end. Instead, their balances roll over to the next year. So the beginning balances of this year were last year's ending balances. Does that sound familiar? Okay. So I tell you these because we want to make sure that we place those in the T accounts. And sure enough, I have. If I go to the T account page, which here is sideways, that's okay, I will turn it. So in materials inventory, this inventory, the first one that we come across in time, beginning balance 1,500, I put it there. Then work in process inventory, the second inventory that we come across in time, $2,700 beginning balance, I put it there as well. Both are on the debit side, normal debit balances, and assets, that's what we expect. Then finished goods inventory, beginning balance of $3,900, again, debit. So those are just in there to start everything off. So no journal entry as such for those. Then in number 2, we will have our first journal entry. We're going to buy some stuff. So purchase $8,000 of direct materials and $1,000 of manufacturing supplies or indirect materials, as we saw in the previous chapter. So for these, our book debits all those to materials inventory. Some books will set up a separate manufacturing supplies or indirect materials account. Our book doesn't. Usually manufacturing supplies or indirect materials is not very big. So let me do a journal entry here for you. It's easy. We will debit or increase materials inventory. Again, that is an asset account, so a debit increases it. We will credit accounts payable or cash. So if we say charge it on account, we will increase or credit our accounts payable. If we pay cash instead, we will credit or reduce our asset of cash. Does that journal entry make sense? So again, increase the asset of materials inventory, decrease the asset of cash, or increase the liability of accounts payable with a credit. Makes sense? Okay. By the way, later it'll be a good idea to go back and just take a blank sheet of paper and write these journal entries down to make sure that you understand them. Just go through the descriptions I have and do the journal entry for each, and you'll understand things. They're not difficult journal entries. Now, I did post this journal entry, or at least the manufacturing related part of it. I wasn't concerned about accounts payable or cash, just concerned about the manufacturing related accounts. So in number 2, I debited materials inventory or increased it by $9,000. Again, I'm not worried about the credit in that journal entry. Okay. Then, coming back to the outline itself, we have journal entry 3. We're going to use $7,000 of direct materials and $400 of manufacturing supplies. So they're going to go from the materials inventory account over to the assembly line. And let's see how we do that. Journal entry number 3. So in journal entry 3, let me say first of all that we are taking the full $7,400 out of materials inventory. So we're going to credit the $7,400 to materials inventory to show that it's a reduction in that account. So a credit to an asset reduces it. Now, this journal entry is called a compound journal entry. A compound journal entry has more than one debit and or more than one credit. So we have 2 debits. The first debit is to work in process for $7,000. That traces the exact amount of direct materials to work in process. You know that work in process inventory consumed exactly $7,000 of direct materials. Then the $400 of manufacturing supplies will get debited to overhead. A debit will increase the overhead account, by the way, just like an asset. It's really not an asset, it's just a very nominal account to tell you the truth. But that $7,000 did increase work in process inventory by a debit. And again, that $7,400 did decrease materials inventory with a credit. It's an asset too. Does this journal entry make sense? Sense? Okay, good. Let's go ahead and post that. Those are all manufacturing related accounts. So in journal entry number 3, I reduced materials inventory by $7,400. I transferred over to the next inventory of work in process the $7,000 of direct materials. Then down here with overhead, I debited $400 of indirect materials or manufacturing supplies to overhead. These debits will be various overhead expenditures, as you'll see. Okay, on that. Again, you've got a PDF of this in the files on Canvas. right, let's come back to the outline itself and look at journal entry number 4. This time, direct labor. So we're going to incur $10,000 of direct labor, including fringe benefits for direct labor workers, and $2,000 of indirect labor. Again, those are people like maintenance people, manufacturing supervisors, etc. So let's see how we do the journal entry for this. Your book is a little bit redundant in the way they do this, but I'm going to follow what they've done. First thing they do is a journal entry for direct labor, where they debit a very nominal direct labor account for $10,000 and credit wages payable, a liability for $10,000. That increases wages payable. Then they turn right around and do a journal entry that cancels direct labor out. They debit work in process for $10,000 and they credit direct labor being a very nominal account they use. That can be done, but it's not the most popular thing. The most popular thing in business is to simply combine these two entries, debit work in process for $10,000 and credit wages payable for $10,000. That would increase the work in process account being an asset. It would increase the wages payable account being a liability for what we owe to our workers. I just do it the way the book does because that's what my accounting lab is going to be looking for. It can get picky. So is everybody with me on these two? I realize again, seems very redundant. Then for indirect labor, it will go into the overhead account with the debit. Credit wages payable to increase wages payable by $2,000. And again, I post those for you in the T accounts. Let me go down here. So I show you this funny direct labor account. In journal entry 4, we debit it. Journal entry 4, we credit it. We zero it out. So again, redundant. In journal entry 4, we have traced 10,000 of direct labor directly to work in process. So that's the sign that we trace it there, the exact amount. And also in journal entry 4, if I bring up overhead down here, we've debited overhead by $2,000. Indirect labor once again. So is everybody okay on number 4? Okay. Well, journal entry 5, it's payday. So our workers are happy. In fact, on Friday is going to be payday at Florida Southern. We get paid once per month, just in time for Halloween. So it's payday. That means we're going to pay off the $12,000 of wages payable. $10,000 for direct labor, $2,000 for the indirect labor. So coming back to the solution. This will simply be a debit to wages payable. If we debit a liability account like that, and payable always signifies a liability, by the way, we've reduced it. In fact, we've zeroed it out. We credited cash, reduced cash that is, for the amount which we pay our employees, $12,000. And let me post those to T accounts for you. here I've got, I had wages payable, whoops. I wasn't worried about it. It's really not a manufacturing related account, and cash is not either. But anyway, if we post it, we would debit wages payable by 10,000, by 12,000, and credit cash by 12,000. So don't worry about it. As long as you know the journal entry, you're okay. Now, number 6, we're going to incur additional overhead of $5,000 in miscellaneous sources. So these could be property taxes on the factory building, insurance on the factory building, depreciation on the factory building, factory machines, et cetera, et cetera, et cetera. So overhead, again, means any cost pertaining to manufacturing except what is direct labor or direct materials. So all those various and sundry costs. Let me go ahead and do a journal entry for you. In the journal entry, we will debit or increase overhead by 5,000. As a credit, I just put various accounts, 5,000. I'm not worried about them. I'm only worried about that $5,000 debit to overhead. So in the overhead account, in the T account, I will debit that for 5,000. Again, don't worry about posting to various accounts. Now in journal entry 7, we're going to allocate overhead to production. We'll assume the overhead is applied or allocated on the basis of budget annual overhead of $75,000 and budget annual direct labor cost of $200,000. Overhead is normally allocated at the end of each reporting period. This company has monthly production reports and a product completion. So let me show you what I'm going to do with that. First thing I'm going to do is to develop an overhead allocation rate. Easy to do. So this so-called predetermined overhead allocation rate, because we're setting it up at the beginning of the year based on budget figures, and it's based on direct labor cost. So we will take in the numerator the budget overhead cost, which is $75,000. We will divide that by the cost driver, which is budget direct labor cost of $200,000. When we do, we will get 0.375, which is the same thing as 37.5%. So normally we would state this as 37.5% of direct labor cost. So if we have $100 of direct labor, we will assume the overhead goes up by $37.50. So we will allocate, in that case, $37.50 of overhead. We simply multiply by how much direct labor we have. In our case, we have $10,000 of direct labor. Again, we multiply by 0.375. That will give us a debit to work in process. So we've increased work in process so far by direct materials and direct labor. Now we do it for the third manufacturing cost of overhead. So debit work in process by $37.50, and we will credit or reduce this overhead account by $37.50. Okay, any questions there about overhead? Pretty easy, good. Well, number 8, finally we complete some product, and we're going to transfer $20,000 of completed product from work in process to finished goods as it rolls off the assembly line. So if we totaled up the job cost records for all the jobs we just completed, they total up to $20,000. This journal entry is going to be very easy. It's just out with the old in with the new. Let me show you what I mean. So it's a debit to finished goods inventory. That increases finished goods being an asset. A credit to work in process inventory. That decreases work in process because work in process, again, is an asset and a crediting will decrease it. Let me post number 8 as well as number 7 for you. If I come back to the T accounts. By the way, number 7 was a debit to work in process and a credit to overhead. Number 8, it's a credit to the old work in process to reduce it and moving it along to finished goods. A debit to finished goods to increase it. So again, it's just like out with the old work in process, in with the new finished goods. Okay. Questions there on number 8. Okay. Almost done with the journal entries. Next thing we do is to sell $18,000 of finished goods. So if we total up the job cost records for everything we just sold, they total up to $18,000. So in doing the journal entry for this, we will debit cost of goods sold, which increases it because it's an expense. And we will, oh, whoops, I have a typo here. Or actually, in writing, that's called a Scrivener's error. So I have a Scrivener's error there, pardon me. Debit cost of goods sold and a credit, that should be to finished goods inventory. So please change WIP to FG. Again, sorry about that. So what we've done, we've increased cost of goods sold being an expense. We have decreased finished goods inventory being an asset. So again, it's like out with the old, in with the new. Now, there will also be a journal entry for the sales revenue itself. We don't know how much it is, but it would be a debit to cash or accounts receivable. Cash if the customer gave us cash, accounts receivable if they said charge it. Both are assets, so they would be increased by whatever the price is. Then sales revenue would be credited for whatever the price is. The credit will increase sales revenue. I'm just worried about this first journal entry here, again being manufacturing related accounts. So this $18,000, I credited finished goods to reduce it. And then down here, I debited cost of goods sold to increase it. So it's rather like out the old finished goods inventory and in with the new cost of goods sold. We no longer have an asset because we no longer own it. It's an expired cost or an expense instead. That takes care of all the journal entries. Any questions about them? Okay. By the way, if I were to come back to the solution, if I were all done with everything, I would foot these T accounts. So for example, materials inventory, I would add the debits, which are $10,500. Subtract the credits, which are $7,400. And I would come up with a debit balance of $3,100, the debit going on the bigger side, which is this one, more dollars. We would expect a debit balance in materials inventory as a normal debit balance because it is an asset. Okay, so I would do the same thing for all the accounts. And what I would like to concentrate on is overhead. With overhead, on this side, which is often called the control side, to control the individual overhead expenditures we have. We have a total of $7,400. On this other side, which is often called the allocated side or applied side, we have $3,750 of overhead that we've allocated. That's a difference of $3,650. This $3,650 is on the debit side because, again, the debit side is greater. Now, if we think about this, in overhead, ideally, if this were year end, how much do you think the ending balance of overhead would be? Ideally. Any guess? Oh, Jen, I see you have a cat too. Mine is hovering around my feet here.
Would they want it to be $3,750 to cancel out?
Yeah, you'd want zero. Yeah, you'd want zero at the end. So you would want to incur exactly what you allocated, but it's not a perfect world, so that seldom happens. If it does, probably time to play the lottery. So let's see what we're going to do about that. Let's go back to the handout. And I'll make this one short, sweet, and simple. So with over-allocated and under-allocated overhead, well, in our case, it's under-allocated. We did not allocate enough. All right, I will show you. So let's assume we're now at year end. And the balances of overhead control and overhead allocated do not equal each other, and they seldom do. Now, this may be because budget overhead and actual overhead incurred did not equal the numerator reason in that formula when we calculated the predetermined overhead allocation rate, or it could be the denominator in that. It could be because the budget quantity of the cost driver did not equal the actual quantity. And again, that could be the denominator reason. We can note that we're allocating overhead under normal absorption costing, which uses that predetermined overhead allocation rate due to timeliness. Actual absorption costing would wait until year end to allocate overhead, and thus would have cost overhead allocated to the exactly equal overhead control. So that would have been nice and accurate, but the problem is it means wait until year end. If we're running a business, we can't wait. So we need more timely information than that. But GAAP errors in here once again in a few places. So under GAAP, our account should approximate actual absorption costing, and that's in accordance with the historical cost principle. So here's what we would do. We would close overhead control and overhead allocated out to each other at year end, and we'll dispose of the difference. And there are 4 ways to dispose of the difference. I'm going to do it the quick and easy way. The other ways you can save until cost accounting. So just here in A, the first way, we can write it off or plug it, in other words, cost of goods sold. It's quick, it's the least desirable way. So let me show you if I come back here to my solution. So 3650, we must zero it out. Overhead has been underallocated. We have not allocated enough. Now, we could have balance overhead on the credit side, in which case overhead is overallocated. Doesn't matter because you'll know that you simply plug it with the opposite figure to zero out the balance. So in our case, we're going to credit overhead by 3650 to zero it out, okay? There we go. So in our case, once again, overhead is underallocated by 3650. And let's only worry about the first method of plugging into cost of goods sold. So we're saying the cost of goods sold, the balance is too low. We should have had it higher, in this case by 3650. So since we didn't allocate enough overhead, let's do it now. We're going to debit cost of goods sold by 3650 and credit overhead by 3650. So we've increased cost of goods sold and we've zeroed out overhead. It's just what we wanted to do. Any questions about that? Under the other methods, it will allocate part of this 3650 to finished goods inventory and to work in process inventory as well, is saying those accounts are stated too low. Does that make sense? Again, more about that if you take upper division cost, and I know you will be, Amber. You will have no trouble with them. Okay. Questions so far? All right. Back here on the outline. Let's see. I would just like for you to know from this last section that we can use job order costing for the services sector. In other words, where we're selling a service, not a physical product. In this case, we will have direct labor, we will have overhead, we will have no direct materials. So the service is simply costed at the total of direct labor plus overhead. That's all you need to know. Okay? Sums up the chapter. So not too bad, huh? Good. By the way, here in chapter 17, you do not need to worry about this problem when it's overhead allocated and job order costing. And you don't need to worry about the solution, obviously. Okay? So then after that, we'll have the chapter that we'll go over next week, which is chapter 19. So no questions. Obviously, if anything arises, just let me know. Always more than happy to help. So have a happy Halloween, and I'll be seeing you on Monday. Okay, take care. Good night.
Professor Quilliam, can I actually ask you a question?
Of course, Amber.
This might be something for cost accounting, but what is like the benefit of using one way versus another in terms of like disposing of the difference?
The advantage of using a method to prorate part of this to work in process and finished goods is that you, in effect, increase them, in our case, by a chunk of the underallocated overhead. Mm-hmm. It's more fair, shall we say. It states them more as something which approximates actual costing.
Okay.
Actually, you'll see in cost accounting, the most accurate way of all is to use accounting software and go back and retroactively state the journal entries to allocate overhead. You'll bring them up to exactly actual costing. So
okay.
Your accounting software has that application. That's the best way to do it of all.
Okay. Thank you.
The plug method for now, you're okay. Anything else?
I just have one quick question. I just wanted to confirm the chapter 15 homework and quiz is the due date is Saturday, correct?
It is, look here. I will be sending you a new schedule, and I push these back by 2 days each. So you're right, it's going to be on Saturday, the 31st instead of the 29th. You're exactly right, Mark.
Perfect, thank you. Just wanted to confirm.
Gotcha. Not a problem. Anything else? Do you have anything, Jen? Okay. Well, very good. So I'll look forward to seeing you on Monday. All right.
Thank you, Professor. Have a good day.
Thanks. You too. Take care, everybody. Bye-bye.